It's July 23rd, 2025, and a little over 3 years ago, I made a video about margin loans and how I use them personally. Back at that time, the interest rate on the margin loans at Interactive Brokers was very low. I think it was below 2%. And well, if you're at this video, you probably know that since then, interest rates have only gone up. Today, the margin loan interest rates at Interactive Brokers start at 6.83% with the Light plan and 5.83% with the Pro plan. They do go down a little bit as you increase in margin loan balance, but I don't think any of us at this video are going to be getting the 4.83% for a margin loan balance of more than $250 million on the Pro plan. If you are, let me know in the comments. I'd love to hear from you. Anyhow, nonetheless, we can all agree that interest rates have gone up. And one of the things that has popped up in the comments of that other video is whether or not I think margin loans are still worth it, and the things I describe in how I use margin loans are still worth it at these high interest rates. So I wanted to talk a little bit about that and cover some things. Now, I guess I'll just start by showing you what my current margin loan balance is, and it is currently $233,997. So $234,000 is how much margin loan debt I personally have right now. And I think that goes without saying at that amount that I do think margin loans and the cost of interest on them are still very much worth it. But I'm still going to break down my thought process for those of you guys out there making the decision on your own. All right. And before we jump into this, I'll kind of preface it by saying this is primarily for those of you out there that are considering withdrawing cash on margin to fund, either expenses in your life, investment opportunities, things like that. This is not so much for those of you guys out there that are looking to trade on margin. That's not really something I do. The fundamental concepts do still apply, but that's really not what this video is going to be about. All right, so let's just kind of jump into it here with the first point, and that is whenever you need capital and you're considering either A, withdrawing on margin, or just liquidating some of your holdings, you have to consider the tax implications. And the capital gains rate on a short-term capital gains is going to be your ordinary income rate. On long-term, it'll either be 15% or 20%, and you may also be subject to a net investment income tax of, I think, 3.8%. So somewhere between, say, 15% on the low side. It could be lower. You could be at a 0% long-term capital gains rate, but you're unlikely to be considering margin loans if you are in that tax bracket. Or you could be on the higher side at close to 24% with long-term capital gains. So if you need cash, you have to consider, how much is it going to cost you in interest versus how much are you going to pay in taxes. And if you just need cash for, let's just say, 60 days because you want to buy a piece of real estate and then refinance to yourself, well, you're going to pay that capital gains tax rate on the amount of, gain you have in what you liquidate. On the flip side, you can calculate out how much you would pay in interest, based on essentially dividing the interest rate by 12. Mind you, this is not technically or literally what it would be, but this gets you in a rough estimate. You can divide this by 12, multiply it by 2 for 2 months, 60 days in the capital that you need, and see where things would come out at. That's one way of doing it. And I think in many cases, particularly if you are a buy and hold investor and you've got a lot of equity or gains built up in your holdings, it will be lower cost to simply borrow the cash you need on margin. And with that, in borrowing on margin, you keep all of your capital exposed to market gains. Roughly 2 out of 3 months in the S&P 500 are positive. So you have a fair chance that in that time you will still make gains on your money. Okay, that is point number one. Point number two has to do with the cost of capital versus the returns in excess of the cost of capital that you could earn with the money that you are ultimately borrowing. So basically what I'm saying here is, if you're going to borrow the money, could you earn a return higher than the interest rate? And to kind of conceptualize this, I wanted to take a look at the performance of an index fund portfolio since interest rates started rising. All right. So on this Morningstar chart right here, actually, we won't go to that just yet. We'll look at the federal funds interest rate. We can see they started rising rates here in March 2022. So we'll use that as our starting point here. And on this chart, starting from March 1, effectively 2022, because this is based on closing price data. That's why it's, on 228 here. We have the S&P 500 index fund represented by Vanguard's mutual fund for the S&P 500 VFINX, and a global 80/20 portfolio represented by Vanguard's Global 80/20 Life Strategy Mutual Fund, VASGX. And we can see the performance of these funds since that March 1 date when the Fed started raising their interest rate. And we can see that despite a little slowdown there in 2022 and the first half of 2023, they've actually done quite well over that roughly 3.5-year period. But what matters is the actual compound annual growth rate, the rate of return on these. And to calculate that, I used our good friend GPT here. And over that time period, which was 3 years, 4 months, and 24 days, or 3.408 of a year, or 3 years, 3.408 years, the S&P 500 had a CAGR of 13.56, and the Global 80/20 had 8.87. Both of these rates of return are higher than the cost of capital here, even at the elevated interest rates. So that's very nice to see. And what juices this up even further is that the interest expense you pay, if you itemize deductions, is tax deductible. So you effectively get a discount on this interest expense by your tax rate. And 6.83% of interest, assuming you're in a 30% tax rate, would be 4.78% in interest. So that is juicing up your returns, and you would compare that to the difference here in the market. So theoretically, you could have levered up, basically just, bought more of either the S&P 500 or the Global 80/20 portfolio. And over this time period, you would have came out ahead. You would have had positive returns net of the cost of capital in your portfolio. Of course, this is all hindsight looking, right? We don't know what the market's going to do going forward. But the point that I want to kind of make here is that even at these high interest rates, they are still below the long-term rate of returns for broad market index funds, are largely allocated to equities. And they do even better, or the numbers are even better, when you consider in the fact that you are taking a tax deduction for your interest expense. Mind you, you have to understand and know whether or not you are or are not taking that tax deduction on the interest expense. So yeah, even at these numbers, things don't really look bad to me, right? I'm still a strong advocate of using margin loans to take advantage of growth opportunities. Now, that said, I really don't recommend using margin loans just to buy more index funds. That does get quite risky. I would use them and do use them to take advantage of bigger opportunities, like buying a business, funding growth in my businesses. Those are really the things. Maybe that is buying an investment property, or making a cash offer on real estate so you can close faster and, buy it at a lower price that still looks appealing to the seller, right? So you kind of win the real estate bidding war, right? Or get a better deal or something like that. that's what you really have to consider, is what type of return are you looking at? And, I just used simple index funds here to illustrate that concept. So yeah, ultimately, as I've said, I think that margin loans are still are still a great opportunity to access capital, even at these interest rates. And you have to consider that it is still going to be lower than other financial products or other types of lending. So for example, if I wanted to buy a business, which is largely what that interest, or not the interest, largely what my margin loan is for right now, because I use that with some other cash to buy a business, compare it to what would be the SBA lending rate of maybe 11% right now, right? So these margin loan rates are pretty much lower than basically anything except for a mortgage on a house. So it's still very economical, still worthwhile. That's my take on it. And as you can see, my skin is in the game. I am using it. You're using margin loans personally here. What's your take on it? Let me know your take in the comments. If there's anything you feel like I missed out on or overlooked, I would love to hear from you. And on that note, if you found this video helpful or insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off on that note.